Today, I'm going to dance around. I mean, not literally, but figuratively. If I were to dance literally, I'm pretty sure something would break. So I'm going to dance around technical analysis a little bit and talk about the Level 2 Limit Order Book. Stay right where you are. Hi, this is Tim from TradingStrategyGuides.com. Thanks for coming back to our channel. Stay around to the end of the video and I'll tell you a little bit about the Comcash Alerts app. Today we're going to talk about the Limit Order Book trading strategy to help you keep up with the sophisticated high-frequency trading machines. The purpose of this video is to teach you how to trade in an order-driven market. We'll talk about the Limit Order Book and how to read it. Most people start their trading careers by studying historical price data and charts. After all, technical analysis is the most widespread form of analyzing the markets, be it stocks, bonds, currencies, or even cryptos. Market technicians try to forecast future market trends by studying price action as compared to order book trading, which relies on studying the limit order book to predict the price. Once technical traders are getting into the essential part of submitting orders, that's when they'll run into trouble. The stock market order book will allow everyone to understand what's going on behind the scenes. At first glance, the order book might look a bit intimidating because they have lots of things going on, like changing numbers and flashing indicators and so on, that make it harder to keep up with if you've never used an order book before. We're going to start by talking about what an order book is, how it works, how orders change it, and lastly, we'll look at a simple limit order book trading strategy that you can use today. Put simply, an order book is an electronic bookkeeping system of all buy and sell orders for a particular instrument, stock, futures, bonds, cryptocurrencies, etc., that includes multiple price levels. Basically, when you look at the order book, you get a visual representation of the order flow. The order book is also known as the limit order book or central limit order book. Each stock exchange, the NYSE, NASDAQ, etc., has its own order book for each security that they trade. For example, for every stock listed on the New York Stock Exchange, there is a limit order book. When someone wants to trade a stock, they will submit a limit order to an exchange. The order book will display the following information about the limit order: the security symbol or stock ticker to tell the exchange what security they want to trade, the order direction, whether they're interested in buying or selling that particular stock, the limit price, which represents the price they would like to trade, and the size, which represents the number of shares or contracts that they are willing to buy or sell. These four things come together to form the limit order. There are two types of limit orders: buy limit orders, also known as bids, and sell limit orders, also known as asks or offers. Understanding these outstanding limit orders is the most important part of order book trading. First, if you gravitate towards short-term trading, the order book is mostly responsible for the price action. Let me explain. The supply and demand imbalances that show on the order book can provide traders with signals to short-term price changes. Day traders and scalpers will find the order book extremely useful. So the shorter the time frame you use, the more important the order book is. Now, the real advantage of order book trading is that it has a very fast learning process, and the more you do it, the better you'll get at it. It also provides a psychological advantage in that you'll become a pro at taking losses. It will be just part of the game, so the pain of taking losses will disappear. Learning how to manage losses in trading is the biggest hurdle for many traders, especially beginning traders. And lastly, the order book forces you to trade what you see and not what you think. When you spot an order book trading opportunity, you'll have to make a split-second decision to get into the trade. In my experience, the skills that you'll develop in order book trading will set the stage for bigger and better things in your development as a trader. Limit orders are arranged in the book by the exchange on a price and time priority. In other words, orders are organized in the book according to price from highest to lowest for the bid prices and from lowest to highest on the ask side. All new limit orders that are submitted to the stock exchange will go into the order book and get sorted out according to the following logic. And for simplicity, let's assume we have a completely empty order book with no bids and asks printed. The first thing we're going to do is add a limit order. For example, if a trader submits a limit order to buy 400 shares of Facebook at $250.40, the broker will submit the order to the exchange. The order will include the stock they are buying, the direction, the price, and the order size. The exchange will also add an order number and the time it was submitted. Since there are no other orders on the book, the limit order will go up to the top of the book on the bid side. Okay, now another limit order gets submitted to the exchange. This time the order is to buy 1,000 shares of Facebook, but they are only willing to pay $250.35. So this bid price is lower than the first one, which means it will go lower on the order book. Given our time and price priority, this order will be placed on the second line of the book. Now a third order gets submitted on the exchange. This time the limit order is to sell 600 shares of Facebook at an asking price of $250.46. Because this is a sell order, it's going to go to the ask side of the order book. Now a fourth limit order is submitted to the market. This order is to buy 200 shares of Facebook at $250.40. Looking at the order book, you can see there is already an order submitted at that price. Since the order book matches the best bid price but is arranged on a time priority too, it means this fourth order will go on line 2. In this case, the order 0102 will be moved down, and then the order 0104 will replace 0102 on the book. And another order comes into the exchange to sell 400 shares of Facebook at an asking price of $250.44. You can see it improves on the best asking price, so it's going to be placed on the top of the book over the previous sell order. The order 0103 will be pushed down and replaced by the new order 0105, which is now sitting at the top of the book. The limit order book is now set up with 5 orders in it. If you really wanted to buy some 200 shares of Facebook stock, you would be able to purchase because there is enough liquidity. In other words, there is a willing seller ready to take the other side of your transaction. The reason why we can purchase Facebook stocks is that there are people who have put limit orders on the order book. So each time a trader puts a limit order into the market, they're adding liquidity. The liquidity allows buyers and sellers to trade in that market. The top of the book is a key part of the order book because it allows you the highest or best bid price and the lowest or best ask price. You should be able to learn how to use the limit order book fairly quickly. That brings us to the limit order book trading strategy. What we want to look at is a manipulation of the order book that often takes place. Canceling orders. This is something known as spoofing the limit order book. Just to be sure we're on the same page, spoofing is the process of submitting large sell or buy limit orders added to the order book, but with no intention to buy or sell at that price. The purpose of spoofing is to manipulate the market price and create a false depiction of liquidity in the market. By doing this, the smart money traders are trying to manipulate one side of the order book, the buy side or the sell side, and convince other market participants to join the market on the same side. However, once enough traders fall for the bait, the large order gets canceled and never gets filled. But instead, the big money traders switch sides and go to the opposite side of the initial limit order.